Good morning, or good evening, or good day, depending on what time you're listening or watching this. Rob McGregor here, and welcome to our On Track end of July edition. It's August 20 as I record this, and looking forward to giving you some update on a very interesting month. Firstly, a quick warning: everything in this update is general advice. So it's designed for clients of McGregor Wealth Management, particularly those using our care investment process and methodology. And if you're watching this and you don't fit that bill, by all means enjoy it, but please get any advice before acting on anything in this video. So we're going to cover, as usual today, we're going to have a look at some of the important economic news that came out during the month and beyond. We're going to put that into context, what's happening in the market, look at what's the returns that have come from different market sectors, and put it all in perspective to what it means to you. So some of the news: firstly, in Australia we saw 10-year government bonds hit 1.08%. That means if you invest in a 10-year government bond, you get 1% every year, and then you'll get your money back in 10 years. So the lowest it's ever been. It actually has dropped below that in August to under 1%, about 0.98. So the first time we've had sub 1% 10-year government bonds in Australia. Hopefully it will lead to the government actually borrowing some money through that effectively and spending it on infrastructure, which will be good for our long-term economy. GDP growth slow in Australia, around the 2%. Inflation just under 2%. We saw iron ore prices go up in the last few months, partly due to continued good growth in China, partly due to one of the main world suppliers, Vale in Brazil, having some challenges there. We saw those prices come back a bit, and hence BHP and Rio Tinto share prices drop back a bit, combined with the impact of the US-China trade wars for them. Been lots of talk about recessions. Everywhere you look in the last few weeks, there's been the media talking about potential recession, and I'll touch on that very specifically that in today's session. Around the world, the US-China war continues. There's a bit of up and down. Trump's intention behind this, there's a lot of good in that. China have been repetitive stealers of IP from around the world, as well as other sneakiness around trade, so calling them out on that is potentially a good thing. His style about how he does it, not always so good, but anyway, we'll see what happens. It will be resolved. China's still growing, what anyone else would call solidly, at around 6.2%. It's slowly moving lower, but that's off a much higher base. Global growth, so that's for the whole world, sitting around the mid-2s. It would arguably be closer to 3 and a bit higher if we didn't have the trade war going on, but either way it's still good growth. We've seen a few tensions around the world, protests in Hong Kong, pro-democracy, and this is part of, it's all linked to China's rise as a superpower, and China's rise economically has been partly driven by their ability to control demand and production, so being state controlled, and they don't have a democracy to answer to. So that has some advantages, and we've seen that with countries like Singapore. On the flip side of any state controlled economy is always human rights abuses, and we see that in China. And the Hong Kong protesters are wanting to make sure that doesn't happen to them. It'd be fascinating to see how that pans out. Very little impact on the world economy and growth on those types of things. Same with US and Iran tensions. That's just a bit of flexing the muscles around the rights and of passage around Iran, and particularly for oil tankers. Leading experts there say there's not much chance of this probably ever simmering into anything major, although the media likes to carry on about that. US growth is slowing. It's still healthy. It's above Australia. It's certainly above Europe and Japan. Just above 2%. The US Federal Reserve, that's equivalent to our RBA, has indicated there's no likely change to interest rates this year. The market consensus is the next move will be down. We've seen the last couple of days Donald Trump trying to talk the Federal Reserve into dropping rates 1%. That's purely self-interest. He doesn't want any talks of recession. He doesn't want any slowdown because that'll impact his chances of being re-elected. next November, November 20, when the US presidential elections will take place, as they do every 4 years. Only one sitting president has ever been re-elected where there's been a recession on their watch, and that's a long, long time ago. So he's probably scared a recession might diminish his chances. Once again, I'll talk about recessions in a minute. So yeah, that's the news. We saw markets come down a little bit. The media certainly carried on as if it was a lot. It was a very little in hindsight. So just to put everything, as always, into context, the Index chart in the top right-hand corner showing that the market grows steadily over time, with occasional booms followed by busts, on average about every 17 years. We've had 8 of those downturns of more than 22% in the last 100 years. The model up in the left-hand column there, boom, bust, wall of worry. So most of the time the market spends in the wall of worry, where we're worried all the time. And we see that at the moment. The world is certainly worried about so many things. That's a good indication that we probably don't need to be worried about a major share market downturn. That's reinforced. You'll see the red squiggle, but if you look at the actual ASX 200 over the last 30 years, you'll see it looks remarkably like that, with predominantly wobbling up the hill in that wall of worry, but then the boom, the FOMO in the 2005 to 2008 period, followed by the bust and the fear. So that model plays out. A big part of what we do is assessing where we are within that cycle, and I'll talk more about that as we go through each market. But firstly, just to reiterate, most investors do mess it up. We see that from the long-term Dalbar. Most investors get less than half of the potential returns on offer. They do it through a number of different ways that we summarize with the phrase mess it up, which stands for all those things you can see. The one I'm going to highlight in this month's On Track is the media. It drives all the others, particularly our emotions. The media is trying to scare us. Bad news sells. And in the multimedia world of online news and everything else, the media must get our attention. They do that by amplifying bad news, ignoring good news, and that makes people watch. So this month it's all been about recessions. So here was a headline in Forbes magazine that's classic media. How long will the looming recession impact global supply chains? So let's forget the global supply chains, which this guy is an expert on, but he's actually said the looming recession as if it's a definite going to happen. He's gone on to say the last 9 recessions have been predicted by yield rate inversion. And yield rate inversion, which he explains, is just where the 10-year bond rate drops below the 2-year treasury rate. He talks about the stock market tumbling, 3.1%, forgetting to say that the market's up about 13% for the year before that 3% natural correction, and giving credit for that onto the recession fears sparked by the inverted yield curve. And then he states with precision that the yield curve inverts roughly 14 months before a recession, as if that's locked in. Well, not quite, as one of my economist colleagues has said. The yield curve's an interesting measure. It's predicted 15 of the last 5 recessions. So let me say that again, 15 of the last 5. So it often goes negative, but it doesn't always lead to a recession. Recessions are nearly always predicted by that. Here's an Australian stat. This is a good example of a media article from the Fin Review from Matthew Cranston, who's stating, and this is after the market sell-off, that Australia's inverted yield curve has given false readings on predicting a recession at least 5 times in the last 30 years. Now, we've only had one recession in the last 30 years, in the 90s, even though the negative yield curve has indicated a recession 5 times. So it's predicted a recession, 5 of the last 1 recessions, to use that cynicism again. So it's an interesting indicator, but lots of things can happen from here. One is the shorter term interest rates will drop even further, which will restore back that yield curve. And the reason it's called inverted yield curve is because we expect to get rewarded higher for longer term interest investments than we would for shorter term, but occasionally it goes the other way. For what it's worth, there's plenty of economists that don't think we're going to get a recession. I would sit in that camp. I think we're into slow growth. I don't think we'll tip into a recession, and not that it matters that much, because share markets can continue to grow during that. The worst recessions to fear from a share market point of view are recessions that follow a massive boom, where interest rates are being increased. At the moment we're seeing them decreased, where we've had massive growth and the Reserve Bank's trying to slow that down. And that invariably triggers a recession. That can often be accompanied by that share market crash, but we're not in those circumstances at all. We don't have massive boom in the share markets. We don't have massive growth in the economy, and the Reserve Bank is cutting rates, not increasing rates. So highly unlikely to have a crash driven by a recession in these circumstances. Let's have a look at what the market's done. Firstly, to Aussie shares. So in the month of July, we were up 3%. Most of that was given back in August, where we are. But that's all that we've given back is 1 month. We're literally back to prices in June, so not a very significant correction, and just that 3%. Long-term returns, very consistent with the historical returns. The chart in the top right is the 1 year. So it's been a typical wall of worry year. We've wobbled up, we've wobbled down, we've wobbled back up, we've wobbled down again. But for the year, we're actually up 9.5%. And that, once again, is before the August correction. So we would have given up a little bit of that. The chart down the bottom, which goes back to 2003, is a really good picture of our model. This is the ASX 200. So we'll see it's risen up to nearly 7,000 in that boom or that FOMO through from 05 to 07, where it doubled effectively in about 4 years. So that's one of the signs of danger times, is where the market's doubled in between 2 to 5 years. At the moment, our market's taken 9 years to double, so it's certainly not in that danger territory. And we see that wobble up the hill, those two channel lines showing that we've wobbled up, wobbled down, but continuing to grow over that period. We currently rate the Aussie share market fair to expensive, so reasonably safe to be buying or selling. We are averaging in for any clients with new money, just to take our time, and if we did see a dip below 6,300, we'd probably put most money in, as that would be good buying at present. And just to show that framework, that squiggle, it looks remarkably like the actual market below there. So let's have a look at US shares now. And US shares have had a very good decade. The return in the last decade for US shares is 16%, so that's sitting above the long-term averages. That would be a double in about 5 or 6 years. So it's in that expensive range. It's not crazy expensive, and you can see that chart down the bottom, which goes back to 2006. It's been a steady climb up the wall of worry. There's no overt boom. The economy is growing slowly, so we're not in that sort of territory where you have a massive boom that can be followed by a bust when the recession brings it on. In the last year, the US share market up 15%. It's not up that much in the US, by the way. Part of that increase for us in Australia is because our dollar has dropped, so the US share market in US terms is only up about 10% for the year. So about a third of that long-term return to us from US shares has come from a falling Aussie dollar. So that brings them back down to more like that 10 or 12% in their own currency, which is very similar to ours. So once again, a little bit expensive, but we don't think in the danger territory. And while interest rates are low, that may well prove to be cheap. US small caps, which are the driving forces of capitalism. That's where the fast-growing companies come through. For us in Australia here, the last year has been flat after a very good long-term return. 10 years there, about 16% as well. Keep in mind, 1/3 of that due to the US dollar, which you can see as the blue line in the bottom right chart there. Good solid gains over the last, in this case we're showing the last 6 years, and you'll see the market's doubled in that 6 years from Australian terms. Not quite that, but a very healthy correction in your active portfolios. We were out of US small caps during the period around October, November last year, before getting back in January, purely because we had such a good run. But very comfortable being back in, and we see them at fair value at the moment. US small caps are also impacted by the trade war, because that's the fast-growing companies, and obviously as global growth slows down, there's a little bit less opportunity for them. Global leaders, so this is represented by IOO, that are in your portfolios in the active portfolio, which is the top 100 companies in the world. A solid year, 12%. 2% for the month of July. The 10-year average sitting at 11%. So this is one of my favourite little exchange traded funds. A simple way to get exposure to the top 100 companies in the world and tap into the natural growth in shares. The top right hand chart is just 1 year. So once again, typical wall of worry. We had the downturn through to January, an increase, and have a look at the relative size of the last little downturn. That little 2 to 3%. It's absolutely nothing. We get at least 3 to 4 of those every year, but it's interesting. The media in this one, because they've linked it to fears of recession, are carrying on, and we've seen markets recover in the last couple of days. So nothing to be concerned about at all. We rate global leaders in that fair to expensive range. Once again, nothing to be worried about, and there's no precision in the way we write these. It's based on our experience, on market statistics, and it doesn't tell us what's going to happen. It just tells us where we are. Emerging market shares have been the area the most hit by the US-China trade wars, and we see that in a lackluster 1 year performance of about 3% and it's about negative 0.9% for the month of July and that was the drive, and you can see that in that last little period, that steep fall. It's not a calamitous fall. It's down around 3 to 4%. So it gave up. We're back to May, and even back to where we were in January. So emerging markets we rate as cheap, and if trade wars fears are diminished, or if they're actually resolved, we would expect to see a big jump in emerging markets, and we do expect emerging markets to outperform in the long run, because this is where the global growth is. It's in China, it's in India. First world countries are not growing much. They're growing in that 2% range for the Australia, US, lower for Europe, Japan. So the growth from the world is coming out of these emerging markets, and it will do for decades and decades to come. But at the moment, those fears around the trade war are keeping growth subdued. I've thrown in gold this month because gold has had a spike in the last little while. Gold in the last 10 years has only returned, it's been about 3 or 4%. It's jumped. We've had a 1 year return now of 25%. A lot of that coming in the last 6 months, and we saw a 3% increase in July, and another spike since July closed. And gold is going up in value, partly because of fears of recession, partly because of the money printing going on in the world. Gold is perceived to be a stable, almost like a currency. So as governments around the world are printing money, that effectively holds gold's value. So gold is a speculation. That is, it doesn't produce any income. So we do hold it in the active portfolio as insurance, and it's been an unusual few months because we've had gold going up while share markets have been going up. Gold will often go down while share markets are going down. So that's led to really good performance in the portfolios, which you'll see shortly. And we will continue to hold gold no matter what. We view it as a good hedge in this world of quantitative easing and money printing, because it becomes a stable currency in its own right. So the performance to the end of July, really rock solid performance. It's above our long-term expectations. That means we would expect some sort of reaction back, and that's why we think the downturns like we're seeing in August at the moment are natural. They'll bring those returns back down a bit. These returns are to the end of July. So as an example, the core balance portfolio showing 3-year returns of about 8.3%, 5-year at about 7.4%, and 1 year at about 8.2%. But notice a lot of that in the 6 months leading up to the end of July from the lows of December and January. The difference between the core portfolios and at the top of the table and the care ones that we show here is that the care ones include the core, the active, and the enhanced. It doesn't take into account the reserves, which is very personalized based on your own situation. You can see my targets on the right over the very long term. That's over 20 years plus. And at the moment, all the portfolios are outperforming those targets. And they're all sitting in the top 10% of their competition, something that we're very pleased about, considering that 70% of our portfolio is low-cost exchange-traded funds, so quite boring. So strategy working well and delivering on our goal of achieving consistent returns that help us plan your future. So let's have a quick look at property. Still lots of red ink around. Prices still falling. There's less red ink. The column on the left is the 1 year change. So pretty much all the capital cities except for Canberra and Hobart are down over the last year. The month of July, a lot more green ink. So we're starting to see some little shoots of growth. With the exception of Adelaide and Perth, monthly figures are pretty fickle. And don't forget, in the long run, even in Sydney, where we've seen a downturn of about 10% over the last couple of years, those markets are still up dramatically on 10 years ago. And property, as always, a long-term investment. If we go to our friends at Heron Todd White, who publish, this is publicly available, a property clock. And a property clock's just an analogy for the market that helps us judge where different markets are at, from being at the peak to at the bottom to declining to rising. It's not a perfect science. You can't predict off this, but if you're in the market for an investment property, it's not a bad way to start filtering. If you're looking to sell, then it's not a bad way to look at what might be a good time in that region to be selling. The changes are noted in orange here. So we've seen Gold Coast added to a declining market there, so seeing some falls there in the Gold Coast. I don't expect those to be very significant. Gold Coast prices still fairly reasonable. They're showing Sydney heading towards that bottom of the market, and places like Melbourne and Perth now they're perceiving at the bottom of the market. You'll note that the next step from the bottom of the market is the start of the recovery. Markets can sit at the bottom for a long time sometimes, so just because they're at the bottom doesn't mean they're going to start to recover, but it certainly means it's a reasonably safe time to be buying, and we see that with Brisbane in particular at the bottom of the market, and Perth. So potentially some good opportunities coming up for people where property is appropriate for their investment strategy, particularly for those of you that are still a long way off retirement, where the gearing can help grow good equity in your world through a well-selected property. As always, very carefully selected. That's houses, units, very similar. There's interesting showing Sunshine Coast at the top of the market there for units, which is interesting, not something I necessarily agree with, but I've learnt to defer to the experts that spend all their time researching this. And keep in mind, there's lots of markets within markets. So even within the Sunshine Coast, you've got some very different activity going, and we do have massive infrastructure spending. Once again, opportunities around the bottom of the market, probably Brisbane in terms of the favoured one for us at the moment. So let's put all of that in perspective and what the current conditions mean to you. And this is something that we rarely change, because all the noise in the market rarely means you should do anything, particularly if you have, as you do have, rock solid foundations, rock solid investments designed for the long run. So steady as she goes, stick with the plan, and the only reason to change is if you need to be buying or selling. It's not a bad time to be buying or selling. As I mentioned, for those that have got fresh new money or new investors into the market, we are building that in slowly. We roughly put in a third of any lump sums at the moment and spread the rest over a year, but we'd be very comfortable having that all in the market at anything below 6,300. So everything we talk about is not signals to trade or to trim, because we're very happy with the long-term structures of the portfolios. There may be better times to buy, as I said, and there may be better times to sell, but we're quite firmly in that wall of worry at the moment. If the market gets a little bit more expensive, then potentially for those of you that are looking to take money out, whether that's for house upgrades, car upgrades, etc., that might be a good time. And if the market gets a bit cheaper, it's a good time to be buying as well. And as I said, we're averaging in new money. Great time for the dollar cost averages for those of you accumulating through the strategy of dollar cost averaging. Plenty of volatility means plenty of shares on sale for your buying. And as usual, we'll rebalance your portfolios when needed, when we sit down and continue to review as always. So just lastly, to finish off, reinforcing our process. And we do say it a lot, but we do believe, we want you to have an exciting life and boring money, and not the other way around. Everything we do is based around your goals, and those goals based on who and what's important to you in your life. Portfolio designed to meet those long-term goals. We do take a long-term view, but portfolios that are there to protect you with some of the short-term volatility, and that protection through massive diversification, through having the right asset allocation to achieve those long-term goals, and having enough liquidity in the short term to ride through the inevitable and always unpredictable volatility. We use low-cost index for most of the growth markets for about 70 to 80% of most of your funds. That helps us deliver above-average returns compared to other investments, and that liquidity helps us protect against short-term volatility through your reserves, and ultimately we protect against short-term volatility with dollar-cost averaging for those of you still growing your investments and rebalancing regularly. That's it. So quite a simple update for this month. I wish you all the best in everything you're doing at the moment. Look forward to seeing you soon, and I'll be talking to you again in about a month's time. Take care. Rob McGregor signing off.